My guest on this podcast is Adam Lawrence. Based locally to me in Birmingham, he's built a £60 million property portfolio and working towards getting that to £100 million. He also has fantastic insight from an economic point of view, really understanding the numbers and data when it comes to property investing. So let's jump straight into the podcast.
I always built the business around cash flow because that simple rule of 95% of things that go bust is because of cash flow. So we must have cash flow. The hardest bit has been going through finding the realistic landlords, because if anyone's ever tried to buy a portfolio, it's harder than buying from a vendor, not just because it's more complex, but your opponent is much more experienced. The reality is your typical landlord still looks like one or two properties, personal name, paying that Section 24 tax, and I've only really had negativity. It doesn't yield very well, etc., etc. And you're still busy working your job or running your business or whatever you're doing, and that property's there as kind of like a pension.
Adam, so pleased to have you here. We first met, we were saying earlier, probably about 13 years ago at a networking event. You've done amazing things since then, on a mission to build a £100 million portfolio. Now, a lot of people say that. You're about 60% of the way there. So let's take it right back to the beginning. How did you first get involved in property?
Well, it was thanks to my dad, really, because we met at a network meeting over in Stratford, if you remember, Stratford upon Avon.
It's actually you were with family, your dad was with you, was somebody else with you? Was there three? Or?
I think it was just me and my dad, because he, at the time, was still working, and he was a tax and trusts consultant. So he got involved in particularly difficult cases and unpicking them and stuff like that. And so he was going looking for work, and he thought, property and tax and trust, that makes sense. And he said, you've always been interested. Do you want to come along? And I was interested. And obviously, as a sort of, I'd watched the financial crash unfold and all the rest of it, and was sitting, thinking, well, prices have come down. Rental market looks pretty strong. And still not building enough houses. That's definitely not changed in the last 13 years. So why not come along and give it a go? And I can't remember whether you were the first or one of the first speakers that I saw. But
I remember which word I was first or second at that day.
Yeah. But so that was where it started. I did 6 months of networking before trying to sort of make too many decisions, and then sort of put my foot down and got on with it.
And what was the first model? What was it that you decided, right, this is the thing that I'm going to do?
So a lot of at the time, what was being talked about, options were being talked about, and then
creative strategies around controlling property.
Yeah, and also it wasn't called BRR at the time, but momentum, or that sort of get a 25% discount was the essential message. And those were the good old days. There were no 3% extra stamp duty. There was none of any of that. So it was a bit easier to make those sort of numbers stack up. And I went on this bit of a journey where I thought, I think most people do really. I think, why would anyone ever sell a property for less than it's worth? And thought, how does that work? And
that's often the biggest hurdle most people struggle with when they get involved in this space. And people say, you just buy it for a discount. Why is somebody going to sell it to you for a discount?
Yeah, absolutely. And I remember reading Simon's Property Magic and thinking, blimey, it's made it sound quite easy in there, but is it really that easy? And then it took a while for me to go through this process and think, well, actually, because he explained in there about, it was the first time I'd heard the term motivated sellers. And thought, well, that makes sense to me. I can see why people would do that. I can see why people would do deals. Maybe let's see how it goes, and how do I go about finding them? And started the old-fashioned way of shoe leather, hitting the agents, hitting the streets, going and talking and looking for deals. And it was a flat market really back then. Started quite close to home.
That meaning prices weren't rising; they were falling either.
Yeah, exactly right. Yeah, and we're not geographically far away from each other. But my first places that I identified to look at closely were Tamworth and Nuneaton, both sort of West Midlands way, and they were.
That's just outside Birmingham. But why not kind of so close to on that literally doorstep? Why not where you live?
So I found I started to look at the demographic side of what area did I want to be in. So at the time, you could still buy in Tamworth below 100,000. And it looked very cheap to me compared to its more expensive cousin, let's say, of Lichfield. And Lichfield very bounded by Greenbelt and all the rest of it. And it's very well connected right on the M42 motorway. Massive investment had gone in from John Lewis at Ventura Park, creating a huge store. And I thought, well, I can't compete with the sort of market intelligence that those big companies have. but I can piggyback it. So surely it makes sense. What does the rent look like? Looked at the yield, looked at what I thought the prospects were for capital growth. I thought that's a goer. And Nuneaton really was to hedge my bets a little bit, and they're both at the either end of a trunk road, so contractors could sort of service both. And it made sense. And Nuneaton was, I didn't have quite the capital growth thoughts that I might get from there, although obviously Coventry's nearby, so that was helpful. But also, I thought I can hedge my bets a bit with yield, because you could buy some... I bought something in Nuneaton at the time, 2-bedroom house, around 50k, something like that. So that it was cheap. It was a fair bit cheaper than Tamworth, and there was some good yielding stock. There's a big hospital there, all the rest of that. So your classic sort of infrastructure play with some capital growth layered in and some yield cash flow in the net.
So it's producing some relatively good income, but also you could see the scope for long-term capital growth as well.
Absolutely.
Was the initial plan always a long-term plan that we're going to keep these for the long term? And
I was very fixed in my mindset in the older days about what it's a bit like, why would anyone sell it at a discount? Well, why would you sell it if you're going to be a long-term holder? It's hassle to buy it. There's frictional costs in buying it. It's not an enjoyable process selling your house into the open market. Auction is auction, and it's normally pretty easy, pretty clean, but you've probably got to take a bit of a hit on the price unless you've got something is going to auction really well. Whereas into the open market, you get fall-throughs, you get this, you get...
Not control at that point once you put it on the market.
There's bits you can do, but you can only nudge and influence. You can't control the process. So it's not fun. And also people forget, if you're going to sell it and it's empty, then there's money to be paid every month. There's council tax rules have changed in that time since we met. All the rest of that stuff. You think, well, actually, it's £1,000 a month to keep this empty. That's not funny. And you then, backtracking that, you get to see why some smaller and perhaps less sophisticated landlords get stuck in a trap where they think, well, I need to sell this now because I can't afford this £1,000 a month while it's empty because I'm on a tracker mortgage and the base rate is high. And then you think, oh, actually, but also they're usually protected by the fact that if they bought it 20 or 30 years ago, even selling what we would call BMV these days, they're still cleared quite a few quid.
After paying their capital gains, they're still walking away with a decent profit.
Exactly. Unless they've leveraged it to the gills, and then they've got a different kind of problem.
Is that necessary? Some people just let that debt get paid down and either very little debt or have the original interest only debt, but might be much, much lower in terms of loan to value.
Yeah, even if you're sort of up in maybe the northeast where capital values haven't moved on so much, if you haven't touched it since 2006, 2007, you're in a place these days where there's some equity built in. Yeah.
And with those purchases, initial ones, and did you add value, improve them, or was it a case, right, they just need to be ready to go, ready to tenant?
So a couple of them, I was looking at HMO at the time to get that extra yield. And so that was the value adder. And those were the good old days when I think we converted one to HMO for about 15k. That feels like yesterday. That tells you it was last decade.
Starting HMOs as well, and we definitely weren't spending 200 grand on each renovation then.
No, and so they worked and cash flowed really well, and they were never empty. The first couple that I did, and so that was the one side of it, and then the other side, it was really looking at, can we have long-term capital growth? But I always built the business around cash flow, because that simple rule of 95% of things that go bust is because of cash flow. So we must have cash flow.
Yeah, must have cash flow. And so then, was it a case of just growing and replicating that, or did it kind of evolve over time, or new ideas get introduced into how you building and growing the business?
So it was a funny time at the time, because obviously it wasn't very easy to get finance apart from anything else. And until I'd run out of the immediate funds that I could access from sort of friends and family and things like that.
That's what started the first few deposits to get going.
Absolutely. And I had a little bit of capital myself, but it was only when I ran out that, and I felt like, I haven't planned this very well, have I? Because now I've got income. Great, but I've got no capital. So what am I going to do? If I sit and wait until that income builds up the next deposit, it's going to be a couple of years before I do anything.
Which was the old school method many people used to do anyway. It's just you save up, put a deposit down, buy another one. And, over 10 years, it might be 4 or 5 houses they've purchased.
Well, that's it. And I suppose I could have gone and said, right, okay, let's find my value in the job market and done something I probably wouldn't have enjoyed that much, but it had thrown off more cash to put into the next deposit. But I didn't really want to go down that route, to be honest. I wanted to do my own thing. And so it was a case of, right, okay, well, actually, I've got income and it's pretty stable. You know, there's several properties, so it's not like there might be one room empty or one flat empty or something, but it's not going to cause a big...
So planning your cash flow generally quite well.
Exactly. And if I can live without touching that, perhaps I use some of that cash flow to service interest on debt. So I can take in some debt, shorter term, longer term, and I can service the interest from the cash flow I've got coming in. And when I started doing that, I thought, right, this is the next level I needed to get to.
Hey, if you're enjoying this podcast, you'll probably realize that Adam and I both met at a networking event. We're both big fans of surrounding ourselves with like-minded people and creating a community around us. So if you want to meet and connect with like-minded people, I've got some great news for you. We hold our monthly networking event here in Birmingham. We have up to about 200 people each month who'd like to meet, network and connect with each other. I'll be sharing some knowledge on stage as well, and also have some great guest speakers as well, sharing their knowledge and expertise as well. So make sure you book on. We'll put the link just here and link it in the description as well. And I look forward to seeing you at the next networking event. So what that did, that brought you more cash in as capital in order to keep growing.
Exactly. So a really simple level, if you were paying 1% a month and you had a couple of £1,000 worth of cash flow, then let's say you, again, keeping it really simple, let's say half of that could be safely used for servicing debt. So I can spare £1,000 a month. So I can borrow 100 grand at 1% a month. Now I've got to pay the 100 grand back at some point. So I do need to think about that. But if I can rotate and add value and use momentum, and that was the first sort of game changer really for me. And also bringing in JV partners who in the first place I probably made the mistake of letting them dictate, did they want to do debt, did they want to do equity? I wasn't particularly sophisticated around that stuff. I was quite good at understanding the corporate structure and protecting myself, but I wasn't good at kind of asserting and going out and raising debt or raising equity. I wasn't going to them with a proposal. They were coming to me saying, I've got money. You seem like you know what you're doing. Let's do something.
Yeah, I know those early fundraising activities, I think many people go, and most people go through the phase of, as part of the deal, I'll wash your car on Saturdays and I'll take the dog for a walk. You're willing to do whatever it takes to get that initial money in.
Yeah, that's right.
And we learn as we go along.
Yeah, that's what Fine & Country do, apparently. If they want to list a property, they'll take the dog for a walk. Yeah. But that's so true. And I think the best way to learn is by doing, isn't it, really? And
nothing beats that.
No. And the landscape was different, but certainly I did learn by doing, and I'm a continual improver. And I like learning. I like education. I like trying. That's part of what I enjoy most about the whole journey, really, because I remember when I first looked into lettings, because it seemed to be a good idea to me to have a look.
So portfolio grows to what we need to manage.
Well, I started spending probably about 30% of my focus was going on property management. And I was also had another trading business at the time, and I was nicking some of my PA's time out of that business to do letting stuff. And I was thinking, this isn't the best way. This can't be the best way. So maybe I should go and look at lettings, and letting agencies must understand best practice. How do they do it? How do they manage property? And then the question I asked myself was, should I try and buy one or buy into one, or should I start one? And that was a sort of another step on the road when the portfolio, we got to about 40 properties by then. So probably I was about 5 years in, something like that, and got to about 40 and thought, yeah, this is, stop it. I could see, very simply, I think the nice way of explaining it is £10 an hour tasks, £100 an hour tasks, £1,000 an hour tasks. And I was getting stuck in £10 an hour tasks. And it was just...
And it can get to a point where all your time is spent just managing, rather than growing and strategy.
Exactly. And that's not why the likes of you and I have done what we've done. We haven't done it to do those jobs, really. We're very happy to lead and inspire and give the benefit of our experience to people doing those jobs. And I do really enjoy that. I enjoy teaching people how to do things, but I'm not necessarily going to enjoy coming in and answering the phone to the leaky tap at 9 o'clock in the morning. It's not going to make me want to get out of bed.
So at this point, were you already doing BMV type deals, or was that still further down the road?
So there was certainly, I understood someone said the old, you make your money on the way in, and that stayed with me. And I thought, that's great. So one of the things that when I took some debt on a slightly longer term basis, so not just for one project, but for several years, because I thought, right, I'm going to go through a number of cycles.
Chunk of cash.
Yep. And if I leave a bit behind, if I need to pay it off, this event here is going to pay it off, or I'm going to sell this property over here and pay it off. So I'm going to use it 6, 7, 8, 9 times in a cycle and then pay it back. And then I'm going to use that to have bought 6, 7, 8, 9 properties. So that'll have created all of that cash flow. And then maybe I've got to sell 2 of those off or 3 of those off to pay it back. But if I do, I'm still net, 3, 4, 5 properties ahead, and then repeated that cycle a whole number of times. So that was, again, a sort of next step along how can I grow a bit faster? How can I start to scale a bit more, but safely within the confines of not taking any ridiculous risks, I suppose.
So it's buying them cheap in the first place.
Yeah.
So there's equity locked in.
Yeah.
And then do you add any value to them, or you just wait and then refinance?
So no, we and this has changed over the last 5 years, particularly because COVID has changed this significantly. I mean, we would do a lot. 2019, we did a lot of buy at good value. You could argue whether it's 25% BMV or not. And where do you add are you adding £1.50 for every pound you're spending, £2 for every pound you're spending, something like that. But one way or another, it washed out, and we achieved a 28% discount overall over the course of that year, over 103 deals. So really, really, the machine was singing, everything worked really well. And then
really ramped it up and scaled in this case of, right, this is the criteria, we need to find these that fit the model, and you've got process of acquiring them, getting them up and running, and the refinance.
I'd spent that time, so 2017 probably did 50-ish, 2018 was more like 75. We did the 100, thought, right, can we do 200 next year? Little thing came along called COVID, which everyone will remember. And I suddenly thought, right, scramble. What's going to change? What's going to happen? Where are we going to go with all of that? And how does this change the business model, of course? And spent a lot of time looking at, because we were quite good on the sort of data collection and analytics side, but this was something I had never planned for. So I then was looking around at what people were saying. You might remember at the time people saying, the market's going to go down 40%. I mean, 40%, incredible numbers. And that's quite depressing when that's, you're at 62% loads of value or whatever. It's all gone, right? It's all gone. And so I thought, right, I'm not sure a lot of this is right. And because I'd done a lot of economics and stuff in my background, in my academic background, I then I thought I was looking around for people I could really trust at the business or the economic level. And I couldn't find them, so I thought I'm going to have to really get stuck into this myself. And it really rekindled my passion for a lot of that stuff as well. And so I started looking into my own, forecasts and predictions and what's really going to happen,
What was your background in economic interest? Because that's somewhat quite unique that you tend to do, is really get into the economic data of property, which very few people do. Yeah. What were you doing previously that kind of transition across into property?
So I always knew data was important, and I remember, like what I said early on, when I looked at Tamworth and the data and the demographics and things like that. So I was always, led at a relatively high level by pretty basic, really, demographic analysis. But my undergraduate degree was in philosophy, politics, and economics, and most of it was economic. My majority was economics. I dropped politics after the first year. I decided that just wasn't really for me, and kept on philosophy on the minor side and economics on the major side. And then I did an MBA around the sort of same time that we met, about a year after we first met, and that had quite a heavy economic tilt. And it was different because my undergrad I'd done before the financial crisis, and that happened. And then, of course, I did that. And then COVID, I really needed another degree, to be honest, because, COVID
maybe change one.
COVID's changed things again, hasn't it? And that was where and I think that was part of the puzzle and the challenge of, someone said to me when I was looking into lettings years ago, they said, the average letting agency only manages around about 70 or 80 units. And they said something quite, well, it's a hard truth, but they tend to grow to their level of competency. And I thought, you know what, I've seen that in a number of businesses. I mean, there's obviously a number of reasons why people grow and scale businesses. And often it's not money, really, which is where people get that wrong. There needs to be a passion for something. And I thought, I wonder how far I can go along this pathway without taking, ridiculous risks to do it. And because COVID came along and it all changed, economics had to change and business strategy had to change as well. So what was singing really well in 2019, I started to then apply, right, what's going to happen with, got picked up very early on, like early 2021, I started talking about inflation was going to be a problem. And then, of course, inflation being a problem is followed by interest rates being a problem. And I'd never traded through that environment. I knew about it from the research that I'd done, but I'd never traded in a sort of 5% plus base rate environment. Although my first block of mixed use block of flats I ever bought was about 6.2% mortgage. So I was conversant with.
But they were slowly declining from when you got involved. The rates were kind of average-ish, and then they started declining. And this was the first experience of rates now potentially changing.
But the market was behind me. There's no two ways about it. The market was behind all of us who had stock at that point. But it was one thing I learned that I was really pleased that I learned when I got rid of those sort of mindset blockers around why does anyone ever sell cheaply, was that I learned people do great deals in every environment. Even in 2006, I've now had the privilege to meet several people who have done some great deals. And you think, the market was booming back then. How did you do those deals? But then what that meant is in 2021, 2022, when again, stock was so short and the market was booming, we did some great deals because I didn't let my mindset think, well, we're never going to be able to do that now. It's like, well, how does this... Listen to the...
There are no deals out there. You're absolutely right. They are on a...
Yeah.
That's your belief.
Exactly. You're beating before you start. You're beating before you get out of bed in the morning. Yeah, exactly right. So that served me really well. But volumes dropped fairly significantly because of the amount of discount we were looking for. And then as the interest rates climbed, the maths has changed, And going back to what I was thinking and what I talked about in the old days of, yes, it's a long-term capital growth play, but we've got some healthy cash flow. I always knew that sort of pre-08, certainly in London, people would pay into the properties every month. People, the same way they do in Australia, they pay in exactly, and they're getting mortgage relief in Australia for doing it. But at some point, that model falls over and the things happen, And so I thought, well, we're going back to a not negative cash flow time because the financiers won't allow it apart from anything else. But if the cash flow is smaller, well, is the capital growth going to come back? But actually, the nuance is it's the rental growth that I was on to sort of 12 months ago thinking, this doesn't look great in year one, this deal. But if I'm right about what rents are doing, then in year two looks okay, 3, happy I've got it. By year 5, I'm delighted I own it, And then hopefully in year 5, I'm also going to be refinancing at a bit of a lower rate. We certainly have peaked in this cycle. And, it's not unreasonable to think we'll be back down in the sort of sub 5% level. It's just we'll be back in the sub 3% level, not unless something significant happens,
And like 5% is probably the norm. It's kind of been the norm for a very long time, but we'll probably end up going forward. So there's people maybe watching or listening to this that want to be involved in property for a few years, and they've only ever known really, really low rates. But that's not the norm.
No, not at all. And, the norm is very much base rate at 3 to 5.5%. So we're at the top of the norm at the moment, and we've been quite high, really. We won't sustain these mega high rates, but I mean, limited company buy to let at the moment, if you want to pay no fee, you're at sort of 6.2%, aren't you? That is high. That is going to come back more to the sort of 4.75% level, I think, over the next 2-3 years.
Yes. And once COVID had kicked in, you started reevaluating kind of what you'd been doing, because you'd had this well-oiled machine creating all this growth. But now it's case, well, actually, hang on a minute, we'll have to stand the brakes on, maybe revisit what we're doing. And how did that then change during COVID and kind of post-COVID as well?
Yeah, so first of all, I backed into a couple of limited company purchases, as in someone showed me a deal, looked at the structure, knew it was in a limited company, and I'd done some training years before about buying limited companies, and I'd not really had the opportunity to do much with it. I had got involved in letting agencies, so I'd done that side of it, but not property limited companies. And then because the stamp duty was because there's a number of tax implications in there, it made what was already a pretty good deal into a no-brainer of a deal. And so great in terms of, your stamp duty reductions. You can finance them a lot more creatively. The funders understand, and they're slightly bigger purchases as well. So when you're getting into the 7-figure purchases, the capital stack changes, the way you're slicing all of that changes, and that was helpful. But really, what it boiled down to was they also took between 4 and 12 months. We weren't used to that. We're used to very quick trading deals, 14-day completion, stuff like that. So completely the other end of the spectrum. Legals were expensive, complicated. There were things being introduced. I was thinking, solicitors are great at telling you what the risk is. They're not great at telling you what the probability of that risk is, or, as you say, how to mitigate it. So you've got to kind of work that one out for yourself, generally speaking. So a little bit of uncharted territory but they worked out really well. So started looking at doing some more of that, but there were there's not millions of them out there, and they're slow burners. So we're always working on that stuff, but it's a pipeline and it's a waiting game. So that was one thing we started doing. But then also I started to think, well, we need more cash flow. I'm coming back to my original roots of cash flow is king. So how are we going to get cash flow when the interest rate's 6-7%? So are we because even if we go back to HMO or something, which I'd stayed away from for years, because probably one of the biggest mistakes I made was I thought the single room banding was just going to be the end of it. I thought it was a one-way track, and they were just going to keep sort of crushing the HMO landlord towards that. And then, of course, since that's now been defeated as completely unfair, that's years of HMO that I didn't do, sort of thing. And then you flip that.
But it's not like you weren't doing anything.
No, very true. But it definitely put me off looking at some stuff which I wish I had done at the same time. And then what also happened is, 2022 came and the energy bills soared and everything else. And it made HMO very, very attractive. All bills included became incredibly attractive. And then, soaring immigration that everybody knows. Most people are coming to the country as a household of one person. Most people are coming to work. Where are you going to live? Where are you going to live? Just HMO. Yeah, exactly. So I missed out on that boom cycle. Not that I think that boom is over, because I think that wave is still riding very much at the moment, and it looks a safer, longer term proposition than it has done for a long time. Whereas, some of the other stuff might look at, they've had a go at the taxation side of furnished holiday lets, and therefore SA, and that's changed a bit in terms of, but demand side, flexibility of living, flexibility of accommodation, it's not going away. So I don't know what will end up coming of all of that, but yeah, HMO certainly feels to me like it's got a lot of legs at the moment. So it was either go and do that on a serious scale and but we couldn't walk away from the single let portfolio that we'd built. And I think it can be challenging to manage both, because it is a bit of a different animal. You're a lot more active when you're managing an HMO. There's so much more to do. Or look at higher yielding, perhaps trading businesses that were producing some cash, that are asset backed generally. So things like care homes would be a great example. There's a property play in there, but there's also a trading business in there. And when you look at the landscape, from a personal perspective, I had two grandparents who both went into care, and it's something that I'm passionate about. They were looked after so well. It was a really good experience, which most people think it's going to be a negative experience. There's always stigma around it. And I thought I'd love to be able to replicate that. And from a commercial perspective, the reality is, we're going to add another 1 million people over the age of 85 over the next, I think it's 12, 13 years. That's going to happen. So we go from 1.6 to 2.6. And the population projections are pretty accurate, because they know how old everybody who already exists is, don't they? So commercially, that's an incredibly attractive marketplace. And actually, at the moment, instead, we've had care homes closing on a net basis, not opening. So there's a supply and demand issue, which I'd love to try and solve some of. And yield-wise, they work better than a single. They're a big HMO, aren't they? They're a big HMO.
With about people living together, you've got additional services like people taking care of them. Essentially, it's the similar concept.
No, it is. It's a higher level of service. And that higher level of effort and service that you put in, the more return you're going to get. That's kind of how business works, isn't it?
And then how did it evolve into doing more commercial property? So you kind of care home, it's a business,
yeah,
and then now you also do some pure commercial as well.
That's right. So I felt after COVID we needed to diversify, and there was a couple of directions. One was around we'd done some of, social housing, leasing to registered providers, stuff like that. But I thought there was a point in the pandemic when I thought it's kind of nice that the government are underwriting these rents, because this was before furlough or anything like that.
So was that for the involvement in that sector? Was that for the certainty of income, or was it because it's a higher level of income that you were able to?
It was more the certainty of income, definitely, at the time. Although, now, again, if you're talking mini-mos and things like that, I could get a bit of both worlds, because I could get the HMO style return from a mini-mo without having to do the management layer on top of that, which I didn't really want to do. So that was how I crossed that bridge. And then that is quite a commercial way to look at a residential property, as is care, really. But then when you go to pure commercial, it was an angle in terms of thinking things like, well, it was fairly obvious office was in trouble, but you can't just write off a whole sector of property like that. Office is a big sector. Were small serviced offices in trouble? I didn't really think so. I thought, if anything, pandemic, recession that might or might not come, that brings change, that brings opportunity. So actually, people will be starting new businesses, and sure enough, we bought a block which was primarily the economic engine in it. This mixed-use site is the serviced office block, and then the secondary bit, entertainment centre, some educational bits and stuff like that. But again, it's a bit like an HMO, it's a CMO or whatever you want to call it, isn't it?
Occupants, if you like, in the one building. Yeah.
So you've got 35 different tenants in there. And so, but also, if anybody doesn't pay, it's a dream compared to a residential situation. So you've got stuff that people demand. We've got it in an area where it wouldn't stack up for Regis, or no one's going to build an office block next door or whatever. It was built with grant-funded money, and we bought it at an absolute fraction of what it cost to build it. And so that made a huge difference.
Key thing that very few people talk about, and especially as you go further up north, often you can buy property for less than what it would cost to build. And that, it's really difficult to get your head around that. You can't build it for what you're buying it for.
It's been a cornerstone of what I've done for a long time, and one property I remember specifically that helped me work this out early on. I just slightly spread my wings from Burton-on-Trent, moving up the A38 from Nuneaton, up to Burton-on-Trent, and bought a property near the hospital in Burton. It was a classic old Victorian end terrace, lovely big bay window, begging to be an HMO. No problem. Bought that, converted it, and then there was also some development going on in a plot of land behind it. Quite a number of new homes being built, 60, 70 new homes. And I remember thinking at the time, I think that's going to be quite positive, that'll help with the valuations and things like that. And then as the automated valuation models have also become more prevalent, I noticed how much because having bought new houses before and seen how they don't really rise in value particularly quickly, but how much they drag up the value of the secondary market stock, because instead of thinking, well, hold on, that's got to be, because they're so expensive to build, even if there's grant funding, well, that's selling at 160, but that house is bigger. Yes, it's older, but it's quite a bit bigger, and it's 120. And the market tends to start to equalise a bit. And I started then using that as more of a driver, as one of my, right, I like this area because we've look at these 200 new homes going in there. It's going to uplift the value of the area. And also it's going to uplift the value of, flats above commercial and things like that as well, the little angles like that. So the commercial play was diversification within property, because I understand it. And again, those sort of sites that maybe you can achieve a 15% yield from, it was interest rate protection as well. And there were a few other little nuances, like what we've ended up doing is running a couple of little trading businesses out of there as well, which is not really what we necessarily wanted to do, but the conference centre has, day facilities. We let rooms by the half day or whatever, and we do a number of conferences. So again, you've got an SA style, but within commercial, and diversity of income streams. You've got things like business rates to contend with that are a slightly different kettle of fish. And sometimes the valuation offices haven't done the best job in terms of rating things, definitely. And we've definitely benefited from leisure having a lot of clemency in business rates, which could be coming to an end, and that could change business models. But you've got multi-purpose spaces. And what I worked out, that I wish I'd worked out sooner, is that the entertainment centre could actually be split into smaller business units that were manageable for people who were local entrepreneurs that are small, passionate about something. Personal trainers, for example. How do you help those people be able to afford the workable space in your commercial building of a decent size? And we've been able to do that with a number of groups, which has been, and also nice for the local community there. It's not local to me, but I've become an extended member of that community from doing that. So I also took that on for learning, because I knew how to do it, but I hadn't done it. Not in that, and there will never be another site like that. It's quite a unique site.
You said going through the process where the learning is really, because you might have theory, but until you actually do it, you don't really get to test that knowledge and is it work like this? And that's where you really understand the nuances in making these things work.
Exactly right. Exactly.
And it seems to me you like the idea of kind of spreading the investments and not having just one model and that's it. So earlier we were talking about the 70, 20, 10 type arrangement. Tell us a little bit more about how your thinking works in that perspective.
Yeah, so it's something that I picked up along the way. And the original sort of 70, 20, 10 I had was 70% decent yielding, core engine assets that definitely have cash flow. Sure, 10% of them at one time might be under refurb, void, on the sale market, whatever. But it's producing everything you need to pay your obligations every month, pay your agents, pay your staff, pay whatever. That's all in that core engine. And then 20% was more what you'd love your portfolio to look like. 3-bed semis by good schools or outstanding schools. So you're going to get longer term tenants in. They're going to be quite low effort, and the capital growth is likely to outperform your core engine.
Your long-term capital growth is much higher.
Exactly. And then 10% would be even higher yielding, but it would be relatively scrappy stuff like shorter lease flats or all sorts of angles you might need to take on, things with legal problems, whatever. That would be the 10% of sort of, so that's really sort of trying to turbocharge the cash flow a little bit to make sure there's always
the slightly challenging stuff where the rewards are much higher by resolving those problems.
That's it. And or you might have to sit on it for a couple of years if you can't get Section 42 to extend leases, or all of that is changing, of course, anyway. So that's where we are. So that 20% I was saying to you earlier on, the problem with that is that we used to call it blue chip, which was a little bit of tongue-in-cheek because we weren't necessarily in the very best parts of the UK, but they were better pieces of stock. But they might yield 5.5% to 6%. Now, when interest rates were 4%, and as you said, they went down to 3%, and maybe even a little bit lower for us to access as limited companies, they stacked up okay. You know, they still
watch the base and generate some profit.
Exactly, and you were happy enough with, you know, a smaller cash flow, but it was still there. When you come back to refinance those at 6%, and look, you can get 4 point something if you want to pay a 7% fee, but I don't want to give away 5 years.
That's always looking at my cost.
Exactly.
Yes.
So I look at that and think, well, at 6.2, it's not a hold, and I think it's very dangerous to hold stuff that's negatively geared. So, you know, your interest rate's higher than your yield. You can do it, but it needs to be a small part of what you're doing. And it becomes, is the juice worth the squeeze? Is it worth holding that stuff? Do I want to really put the 70 to subsidise that part of the portfolio? Because I was happy to accept lower returns in the now, but I'm not really happy to accept negative cash for a positive return over time. And my return on equity is not exciting anymore. So actually, maybe it's time to release those.
And the landlord kind of landscape has changed a lot over the last 20 odd years and stuff. And you know, so the only certainty in this market is constant change. We're just always evolving, and there's nothing that you can say this is it for the next few years now. And you see landlords starting to sell as well and exit because it's just not what it was. What's your experience of landlords exiting the market?
I think they've been talking about it since George Osborne's 2015 summer budget. I think talking is not always the same as action, but I think the real bite of the tax changes, and let's call it what it is, the hostility really towards landlord from a governmental, or towards individual landlords anyway, to be clear, or towards individual landlords that manage secondary stock. They're quite happy with big build-to-rent landlords. That's what they want. But it's a pipe dream to think that they can replace the 5+ million private rental sector homes with build-to-rent. So that's been forced into overdrive by, if you remember when good old George did those tax changes, he phased them in over 4 years because he knew it could be quite damaging, right? And then what really happened is it didn't really bite because over those 4 years, the interest rate carried on sort of decaying. So yes, it was a pain for landlords, but they were paying base rate +2.
Hurting, but not in real pain.
Yeah, they were annoyed by what they were. It was not fair to them that they were getting taxed on effectively on turnover more than profit, And you can understand that, but it wasn't causing a real problem. When the base rate went to 5.25, a lot of them, million plus by all accounts, are still on these older tracker mortgages. Suddenly it really bites, because suddenly within the space of 18 months, it's gone from 0.1 to 5.25, add on their 2% margin or whatever, they've gone from 2% mortgages to 7.25 and Section 24 on top, so they can't even expense all of that, and suddenly it's a nightmare. So that has had a massive impact. And the number that came out of that survey, which was from Hamptons International, was 160,000 selling up. The problem we have is that all of these figures, when they actually come through in the governmental reports, they're 18 months out of date. And we need to act now if we see opportunity. But you can see left, right and centre, the hardest bit has been going through finding the realistic landlords, because if anyone's ever tried to buy a portfolio, it's harder than buying from a vendor, not just because it's more complex, but your opponent is much more experienced, and the idea of the tired landlord, sure there are, and it's a tiring game and people get tired, but it's much less likely that they have to give stuff away.
And they will have built up capital over time on these, so they've got some profit locked in. Yeah. And so they're thinking about, well, they need to extract that. They've got capital gains they need to pay. So even if they're selling a little bit of a discount, and most people don't want to sell at discount. Why would they? They're not in severe pain that they need to sell it. So it's timing that exit for them as well. So capital gains allowance is disappearing as well.
Absolutely. And it's likely that, capital gains tax probably on the way up, certainly over time.
Yes. And one of the things that you've done quite well, we were talking off camera, is that the portfolio is spread wide across the country, up to Scotland and across to Wales as well. How have you found that experience of working on properties, managing them, the day-to-day maintenance, the refurbishment when you're hundreds of miles away?
So we were at a stage once where we had our licenses to manage in Scotland, Wales and England, right, from our own internal agency. But Scotland particularly, the law is really quite different. And with all of the changes, and with the fact that some of our stuff in Scotland, again, during COVID, we agreed a portfolio purchase had quite a bit of LHA stock in it. And I think that stuff really is very difficult to manage remotely. You need boots on the ground and local knowledge. You really benefit from that. So we then decided, do you know what, actually, let's transition all that Scottish stock out, and we'll stick with managing in England and Wales, where, of course, there are still different rules, and there's Rent Smart Wales to contend with and all the rest of it. And when we were talking about this off camera, we were saying, well, the grass can be greener. Sometimes I can look and think, someone who can, the portfolio spread within a 5-mile radius or whatever, what a great idea. But sometimes we've gone further afield to get those deals where we can get our money back out of. Could we have done 103 deals in Birmingham in 2019 and pulled all our money out? We couldn't. No. If anybody did that, more power to them. But I think it's just too competitive. There's too many people who work to a lower margin. Whereas if we were willing to go to places where, and we would buy everything, but if we had a view on, like 2019, I had a view Wales was probably likely to achieve reasonable capital growth, and the toll had come off the bridge and all this stuff that was still happening, and it worked out pretty well. So I was pleased that we did get that level of exposure, but it's more costly. If we want to do a viewing, we're using Viewber or someone like that, and there's a cost implication to that that's not the same as someone in the office can whip out in the car. It's probably costing us twice as much money as that is. If we want to do, so we tend to do open houses and things like that. If we want to do an inspection, which of course we do want to do, again, we've got to pay a contractor to do that, rather than you might get around 20 properties in a day if you got someone to do it and you organise yourself well. Whereas if we do that, 20 inspections, it's going to cost us a lot more than that, and they're not going to get around them in a day. So there are cost implications, which mean that you've got to be quite sensible and good at controlling costs as well, because you've still got to deliver decent property at the end of the day. But you will never get that level of relationship that sometimes is so powerful between a landlord and a tenant that nobody really wants to talk about when they're attacking the landlords. But I've only seen, really, no, I'm not saying I've never seen bad landlords, but I've seen landlords who are really, there's a real genuine kindness and a bond. And I've had tenants like that myself early days who, I still speak to today and things like that. And basically, I did my bit, they did their bit. No one was bitter about it. It worked for them at the time. They're now 10, 20, 15 years further on, and they've moved on and they own houses and all the rest of it. And there we go.
Absolutely. And I think very few people talk about landlording. Really, it's a business, but it's a service as well. And when you have an instance where a tenant, for example, is not paying rent, it's so difficult compared to any other scenario. If you took the property context out of it, and it was another situation where somebody had taken on a service and not paid for it, there's lots of recourse available. But actually, in this sector, we are, we're penalised from many different angles.
It's incredibly difficult to get your head around that, and I think that part of the diversification route and everything else, if you start getting involved in trading businesses, you're going to have more people, you're going to have more staff. There's going to be more HR considerations to make. People are not necessarily going to do what they say they're going to do. Landlords sometimes don't, tenants sometimes don't, staff members sometimes don't. So a different kind of headache that you're going to have to deal with on a more regular basis. But when you've got good people, the rewards are so good for you and for them, and that's how you're trying to create win-win partnerships for people on that side of things. But yeah, there's nothing like the level of defence that people would like to put in for tenants not paying, or some people would like to put in. I don't know how hard they think they can push the sector, because you've still got, I was surprised to read the other day, 94% of all rental property is still in personal names. 94%. And you think, I know the likes of us feel a bit like we live in a bubble sometimes and it's all limited company, but we're the exception, we're not the rule.
We tend to surround ourselves with people of a like mindset, so we just assume it's the same for everyone.
Exactly. But the reality is your typical landlord still looks like one or two properties, personal name, paying that Section 24 tax, and have only really had negativity, and over the last couple of years have then had the interest rate to deal with. And if you moved out of your house before the one that you live in now, you probably didn't buy that one with investment in mind. So it probably fits in my blue chip category. It doesn't yield very well, etc., etc. And you're still busy working your job or running your business or whatever you're doing, and that property's there as kind of like a pension. But again, you're not willing to lose 150 quid a month to hold on to it necessarily. And certainly not in this day and age, when you sit and think, well, hold on, a lot of these, we got them at 150, they were worth 200, now they're worth 250. You sit at that level and think, well, hold on, there's 100 grand in there. I can do something with that. I can redeploy that. I can, make some things happen. If you make your money on the way in, if you stick with that, you need more capital to keep feeding the front end of the machine.
Do you think those smaller landlords, one or two properties, and they've no aspirations of doing more, they've just kind of accidentally ended up with those, kid went to university because the previous home or whatever it might be. Do you think the government will slowly squeeze those people out of the market? Do you think that's kind of where it's heading?
I do, and I worry. I see the idea. I've seen the concept written down of how the institutions get introduced. And they're slow. They're very, very slow, and we are so far behind other Western democracies in terms of how much property is owned by institutions. It takes us 30 years to catch up at the sort of pace they want to go. And what worries me the most is you never hear any side of the political spectrum talking about the transition. I mean, if we say this started in 2015, because I think George Osborne's message was pretty clear, we're 9 years in as we have this conversation, 9 years in, and we're at about 85,000 build-to-rent units in a private rented sector that's 5.5 million units wide. I mean,
they need 350,000 a year.
It's a pebble. It's an absolute pebble. And so no one talks about the dangers in transition. And I think no one really appreciates that, again, like you said, rent arrears is very different from any other. You shoplift in Tesco, hopefully you get arrested. It's just not the same thing at all. And there's massive differences in so many parts of property, including the supply side is a massive challenge and is going to continue to be a massive challenge, let alone the amount of old stock we've got, the energy performance, all the rest of it. And if someone just talked about the fact that when a decision is made about extra compliance or extra regulation or anything, I'm not trying to fight that, I'm not against it. As a bigger landlord, it's probably on my side because it probably means another 1,000 people want to sell up and I might be able to pick up a few deals, right? But they're spending the tenants' money as well as the landlords. In any other business, people would have no problem with understanding if the price that I buy my rubber in at and I make wetsuits, let's say, if the price of my rubber goes up, the price of my wetsuit has to go up. It probably didn't go up as much as the price of my rubber. it's going to squeeze my margin a little bit. That is economics. That's the game, right? But it does put the price of the wetsuit up. So if the price of delivering the rental property goes up, then the price of the rental property goes up. And of course, interest rates had a big impact on that. But it's not just interest rate. Everything else that you introduce, every selective license, every this, every that, it has an impact on rents upwards. Why are we honest about it?
Very few landlords that will just absorb all that. Very, very few. Either they're thinking about exiting and leaving the market, which causes another problem, or that gets passed on in terms of rent increase. And we've seen rents just go crazy in the last couple of years in terms of what the rents are.
Yeah.
We touched on institutional investors. So we've got the aspirations of like Lloyd wanting to become the biggest landlords in the country, residential landlords, and John Lewis and others kind of jumping into this space. Do you think what is it do you think they've seen now that's encouraging them to get involved in this sector where previously they had no interest in getting involved in residential property?
I think they're seeing it as the last bastion of solid, dependable returns, because what did they used to do? They would look at things like retail property funds, whereas you see some of these shopping centres and things, assets that have changed hands, they've been sold at less than half of what they were bought for. Yes, they've delivered yield, but commercial has yield-based sensitivity, really significant yield-based sensitivity. They see and they know property's likely to carry on going up in value over time. That much is a near banker. There'll be cycles, there'll be accelerated bits. There'll be bits like the last 18 months where it hasn't done so well or it's dropped a bit in various parts of the country or whatever. It will be cyclical, but they're taking a 20, 30, 40 year. And I think, behind the scenes also, the government are saying to them, the water's warm here. We want you guys in there. Sending in fact, above the line, they send pretty positive messaging out to them to say, we want you guys in here. What does it take to get you to deliver? And whether there's promises of future tax breaks or whether that sort of thing is on the cards, it wouldn't surprise me. But what you see more often than not as well is some of these funds buying assets that belong to another fund. And it makes a big headline, but you think, well, that's added 0 units to anybody. So I'm very glad that Blackstone have got involved in that deal or whatever, and they know what they're doing. So it's nice. If Blackstone are in, you're pretty sure you want to be in, and that's cool. But it's not delivering 10,000 new units or what the government really want and need. So, yes, it becomes more X buys Y, Y buys Z, whatever, And they're all still, I think, a little bit scared of the stock that is more than 30, 40 years old, because they worry they are taking these long-term views and they sit back and say, well, hold on, the roof's going to need doing at some point. And you or I may be able to get a friendly roofing contractor to get the roof done for a reasonable price. But someone in Blackstone's HQ is sitting there going, well, these roofs are 11,000 quid or whatever they are. And therefore, that's got to be done every 80 years. So when you start to amortise all of those bits, and if you pay the sort of full value, it costs a lot more for a housing association to do a refurb than it costs for you or I to do it. There's just more layers of people involved.
And it's still quite new. We haven't gone through a kind of a cycle with these big institutional landlords of their real appetite for this stuff.
No.
So it'll be interesting to see what happens here.
I'd imagine there's an awful lot more money out there than what they can actually park it into. I mean, John Lewis wanted to, you'd think, well, hold on, they've got the property already. They were going to develop all these flats. But you were looking at some of the build costs they were being quoted. We thought, well, this isn't going to work. And sure enough,
that's happened, is it?
And that's it.
They've sent it up and do it.
Not going to happen to it. It's too expensive to build. Modula is great. You can do modular. You can crane it in. Try doing that in front of a John Lewis store. It's kind of busy places normally. So it's not happening.
You've also been a big fan of community and the people who talk about surrounding people around us and stuff. And, you and I kind of love the idea of kind of being around people who are similar, like-minded. Tell me a little bit more about the community you've created around you.
Yes, so it was 7 years ago now, unbelievably, but 7 years ago, thought, right, we want to do something different that's not just networking, that adds some real value, and ended up developing into a community. So I had a lot of great conversations with people when I was in the early days of starting up my business, and lots of help, deals, contacts, trades, knowledge, all of that. And I was lucky enough as well to get invited to a few sort of private groups that were very much, you have your much bigger networking events that take place across the country or whatever. There's a process that they're following. There's people in the room. They're generally targeting people who are new to property, and then there'll be a few more experienced people in the room. There'll be some service providers, and that serves a purpose. But when you're not new anymore, how do you fit unless you're one of the service providers? Whereas I went to these closed networks, and they were completely the opposite. Quite guarded, would never go to the bigger sort of corporate networking, and they were very valuable. I met some great people in those rooms, but it was it's almost like the little slot opens, like I don't even remember how I got my first invite to one of those, and I thought, isn't it a shame that's not accessible to people? That you could be able to take those values and make that more broadly accessible, and try and do that. First thoughts were all over the country. We haven't managed to do that, but we've managed, presence in the southwest with Bristol, presence in London, and a presence in Birmingham, and a monthly meeting, and then broader, hundreds and hundreds of hours of video content. We video everything we get done. We do get people who don't normally do like the networking circuit to come and talk, and so there's a different feel, and it's a bit longer.
Yes, and there's their daytime as well.
Their daytime meets, that's right. And then we'll have a round table sessions in the afternoon where that's not being filmed, but it is much more open chat. And we get some really quite experienced people. We still welcome and attract people who are relatively new to property, absolutely, and we always will. But it's created that kind of safe space for people to come to where they know they can come there every month, they know what they're going to get from it, and they help each other. It's great to see how much they help each other. So it becomes a concept that's way bigger than a me or a Sue or anybody. It's partners in property, and it's its own.
And I think the idea of bringing people together with just the content that brings the people together, and then enormous opportunities come from that. People getting to know each other, connecting with each other, learning from each other as well.
It's not necessarily a master strategic plan. It's a put good people in a room and good things will happen.
Absolutely. And you've become phenomenally well known for your economic outlook on the property market, and I enjoy reading some of them. I think have a great insight into the numbers and analyze, which very few people do. And you also now put some back content out on YouTube as well. So what's the YouTube channel? Let's send some love and subscribe your way.
I appreciate that. Thank you. So it's called Propenomics with Adam Lawrence. And so I obviously put property and economics together, Googled it. No one had ever done that before. So I thought, right, I've got my own word. That's brilliant. And I always make sure I release something on a Sunday morning that I've written. And then people, honestly, lots of people don't really want to read these days. They'd rather have the audio or the video content. So it turned into a bit of a podcast on the back of that as well. And I'm trialing some different things. I did a little live this Sunday morning to talk through my thoughts. And then if anybody wanted to, they could sort of jump on and say, what are you trying to do here? But I'm trying to search for the truth, and I'm trying to organise my own thoughts, because, there's a pretty big bat that I'm swinging around. I've got joint venture partners who've got money at risk or want to keep growing the portfolio sustainably. That growth rate has been impacted by COVID, as we were saying earlier, but I need to be on top of what's the next surprise. I don't want to be surprised by the next surprise. When I see the economic news these days, I'm like, I pretty much knew that was going to happen, or I had a slightly different view on what was going to happen. So I developed these longer term views on the interest rate and where it would get to, and it was helpful last year when we were seeing rates sort of climb up, and it's like, where's this going to stop? Well, it showed me. I called the top pretty much at the top, which is not easy to do, and there aren't many people trying to do it either, because why are they interested in it? But I've been stunned by how many forecasters just throw out a forecast and then just walk away from it. And I just think there should be...
Without the explanation.
Yeah, and there should be... Why are you thinking you're going to get there? And then if you've got it wrong, why do you think... We don't learn anything when we get it right, do we? We only learn when we get it wrong. So I'd like to go back and go, what I got wrong there was this. What I didn't see there was this. I should have seen this earlier, and it's helping me to evolve and get better at what... Because I've got to keep upskilling myself if I'm going to keep growing the business. There's no two ways about it.
Yes. And in terms of your thoughts on the next year to next 5 years, what's your thoughts on the UK property market?
So I'm really bullish on both rent growth and capital growth over the next 5. One of the mistakes people sometimes make with rent growth is they're talking only about the figures that come out from your Zooplas and home lets and people like that. Well, that's for new lets, right? But really, we should be looking at rents for existing lets, because most of what we have is not new tenancies every year.
That doesn't get reported into your Zoopla data and stuff.
There is an ONS rental market index figure, which is relatively new to the market. The paucity of the data in rental is mind-blowing, really, when you think how big the sector is. And, there's trillions of pounds worth of assets and rents and stuff involved, hundreds of billions of pounds worth of rents. It beggars belief, really. But I think rent growth and capital growth will probably about match each other over the next 5 years. But I think we've obviously got big rent growth at the moment, and it's going to calm down. Wages are going to calm down, which will also calm rent growth down, because one is obviously enabling affordability for the other. But when you look at inflation-adjusted house prices, they're cheap at the moment. They're as cheap as they've been for a long time. The cheapest since 2013, right? Early 2013, when, aside from your Londons of the world, everything was still pretty flat market. It wasn't going anywhere fast. And I was out there doing a couple of deals in those markets, and remember, how relatively flat they were, and they were good for doing deals in. But I see a climb on that side of things without a doubt, because you've got more affordability now than you've had for some time. The blocker, of course, will remain the interest rate for a while, but people forget that we've been underwritten. As a residential buyer, you've been underwritten at a 5.5% mortgage rate for the last 12 years. That's been the rules that were set into stone by the Prudential Regulation Authority. So if we're under 5.5, people will still be able to afford it. Now, will they want to spend it? And that's no comfort for people coming off a 2% mortgage and going on to a 4.75% one, as they are at the moment. But where's that money still? They can afford it. It just has to come out of their disposable income. And they're not spending it on holidays and whatever other things that they were able to afford when credit was super cheap. But the likelihood is rates are coming down somewhat slowly from here, but that's going to give another runway. We're going to repeat that cycle that we saw, between sort of 2011 and 2015, 16 before the referendum, where
there'll be a little burst,
gradual rise, and then there'll be a year where everyone turns around and go, where did that 7.5% come from? But it's in the pipeline, and you're already seeing in real time now, figures agreed per square foot are 5% ahead of where they were 5 or 6 months ago. So that will wash out into the land reg as we go later through the year. But it's not easy to try and juggle all of these. Like this morning would have been a great example. There was unemployment figures released, and unemployment was up a bit more than expected. But in real time, jobs were being created. But this is the unemployment was reported a month and a half in arrears. This is it. So this is why I try and keep my fingers on the pulse of what's going on in the now. So I'm not going to be. Am I thinking, oh no, we're heading towards a brick wall? Lots of people are going to lose their jobs. There's problems with affordability. I'm very confident that we're not. For example, because I'm on top of that side of things.
Yes. Adam, I've loved this conversation. It's always fascinating listening to you and the insights and your thoughts on the economic market when it comes to property. What's the best way for people to connect with you?
So I would say go onto my LinkedIn, Adam Lawrence on LinkedIn, send me a connection request on there, give me a follow on there, or go to the YouTube channel and maybe try and tune into one of the live videos and make a comment, and I'll see if I can add any value to your questions.
Excellent. We'll put the links in on the screen and in the description as well for both the YouTube channel and also for LinkedIn as well.
Appreciate that.
Thank you so much.